Hello, everybody, and welcome to your latest edition of The Officials. Today is August 29th. Please remember to like and subscribe to our weekly presentation. We have some, I guess, slightly different things to say today. To start, let me tell you where the price is right now, 79. So you can mark us against that for the next coming week. Also, regarding the officials this morning, we closed the day at, on Brent, 78 and 39 cents. So the market has been running up since this morning to midday here in London. And what I would like to do today, before anything, is welcome the latest addition to the officials, Ed HB. So welcome aboard, and you'll have your time in the sun in the next few minutes. But to start here, let's do a little bit of a wrap up of what has happened since the last episode of the officials. We were a week ago. We were expecting Mr. Powell to come out strongly and signal that he would cut rates in mid-September. He didn't disappoint us at all. In fact, he came in a little bit stronger than I guess the market was expecting in his language. And while all of us were expecting that he would signal a cut, somehow the market reacted as if they didn't know. And the price ran up, the price of various commodities went up, the price of gold went up, and the dollar fell as it should have because it's becoming less valuable on a trade balance basis, and then the euro went up, and all the other currencies globally, the pound, the yen, everything went up against the US dollar. And this is the response, in a way, was a little bit too much and too soon. But it almost seems like the market was poised and ready for good news to run up in oil. So it did. And then over the weekend, there was also further military activity between Hezbollah and Israel. And a lot of rockets were fired from Lebanon to Israel, and Israel bombed a lot of sites in Lebanon, and the market ran up like crazy on Monday. And in fact, it hit a high of 81.52. So miles away from where we are now at 79. So after hitting all those highs, it soon corrected. And the question that I have here is dual. Why did the market react so violently, in a way, to Powell's comments? And then subsequently, why it cooled so fast? So let me start with the first part of the conversation with our perennial guest here, Harry. Why do you think the market reacted so strongly, even though it was so pre-signal that he would say, that Powell would say he would cut interest rates?
I think, Jorge, you hit the nail on the head by saying Powell's language, because Powell has been extremely conservative, extremely cautious when it comes to giving forward guidance at every press conference after each FOMC. And what Jerome Powell did is go a little bit beyond perhaps his comfort zone. He said that further deterioration in the labor market was not welcome. He says the path is clear. So I think in terms of messaging, in terms of dissecting the words, the commas, people looked at that signal through the language as being a lot more forceful than simply saying the time has come, but the economic data, but the balance of risk. All of these things were incorporated in his message. But I think at the end of the day, it is his messaging that allowed that feel-good factor in excess of what we were expecting.
So what I would then conclude by marrying what you are saying and the question I had is that Powell got spooked by the correction in the labor numbers that were issued, I believe, Wednesday or some
It's
such
possible.
date.
There was nearly a million jobs missing from the numbers.
And therefore, maybe the market is waiting, well, is saying definitely interest rates will be cut between 25 and 50 points. And then
I think that's the
commodities
interesting,
went up.
that's the second interesting point, is that while we had a very forceful, yes, the Fed is on track to cut, we didn't get any hints as to the amount. And the other thing now is like the feel-good factor, as you know, when you get policy announcements or headline announcements like these, the market feels good for 2-3 days, and then reality sinks in again. The next FOMC meeting is on the 18th of September. So we still have a long ways to go before we get that rate cut, whether it comes in the form of a 25 basis point cut or a 50 basis point cut.
And if you were poised or ready to listen to bullish signals from the market, well, you had the incidents in the Middle East over the weekend, and then also the Libyan cuts, which led to that rise to 81.50, but then it corrected. Why do you think it corrected so sudden after rising to 81.50? Dr. Wu, and I know you have been very bullish. So I was looking at the numbers and saying, Dr. Wu is right. This market is going up, but then it came crashing right down. Why do you think that happened?
Yes, I was vindicated early in the week, but the market did fall back very quickly. Brent is very much momentum driven right now, although the Libya headlines was a bullish catalyst for the market. They soon came to perhaps realize or expect that the supply disruptions is more of a short-term thing rather than in the medium or long term, because with divided governments and oil revenues making a big part of, they're very reliant on these oil revenues, so it's in their interest to get these things sorted sooner than later, and therefore bring back oil production. But it's also worth noting that the physical crude market has remained strong in light of this situation, because reduced Libyan flows into the Mediterranean has driven up physical differentials, and we're seeing the North Sea market still very strong. Even Osberg, Ekofisk seeing bids which are very, very rare in normal times.
This brings the point that there are macro issues and micro issues, which you're highlighting. There are a lot of micro issues. Like I have seen a lot of buying of Dubai by Vitol in Asia, which I scratch my head as to why are they buying so many cargoes and where they're taking them to. And of course, we'll uncover that in the next few reporting days. But there are a lot of still macro issues that are rather negative. So I'll give the floor to Ed. What do you see in Germany and in China in the past week or days that highlights those macro bearish elements?
Well, they've both been very, very negative, really, in their macroeconomic trends. So Germany, for instance, the whole economy seems to be in this kind of stagnant state. There's been very little growth in the last 4 years or so. I believe it's only gone up by about 0.4% in GDP terms in 4 years. So it's really not growing at all. So the demand there isn't rising as you might expect or hope if you're in a kind of bullish mood. And then, of course, China as well. This whole year has been struggling quite a lot at least in the recent quarter, and some of the banks have just revised down their projections for GDP growth both in 2024 and into 2025. So I think that was UBS have revised it down as of this morning or yesterday. Morgan Stanley have also been relatively negative, as of Goldman Sachs. So that large consumer of crude oil is obviously not performing as would be hoped by the market. So we're expecting to see that kind of that demand decrease, and therefore be more of a bearish factor for the overall oil market. And I can actually, I think, invite now in Michal Meidan, who's an expert in Chinese energy issues. So I'm going to give up my seat, and then she'll come in and take my place to give a bit more of an expert review of China's situation.
Thank you, Ed. Much appreciated. Michal Meidan, thank you for joining us in this program. Short notice, and I really appreciate that you're joining us.
Thank you, Jorge. It's amazing to be a guest official.
You're visiting here our office today, and you had some conversations regarding economic matters with Harry T. And as it happens, I'm going to be in Asia for an extended period in the coming weeks, going to APEC and also getting a sense of what is really happening in China. I'm very looking forward to those visits and really seeing from the ground up what's happening there. We all talk a lot about China because it's such a large component of the world economy. But to be fair, and this in a way bugs me, is we talk a lot, but we don't know a lot. They're a little bit inscrutable, and we don't visit there as often. So when I saw you in our offices, I was very keen to know how you see their economy. In particular, how do you see their energy demand? If you could share us a little bit of gas, a little bit of oil, how do you see them for the rest of the year and the year after?
Sure. And I think as you guys have been talking about, the picture's not pretty, right? Sentiment is very weak. It's been a difficult year. The real estate downturn, local government finances. I think most importantly, and it'll be interesting to see how much that comes across when you're there, people are not happy. Expenditure is down, people are going out less. I think you will also see that the changes to the kind of structural economy are pretty fundamental. You'll see EVs everywhere, you'll see robots everywhere, you'll see a lot of automation, a lot of digitization and efficiency gains. But that, and I think also the market kind of goes from ultra bullish to ultra bearish about China. It's kind of 1 or 0. It's either there's going to be a stimulus and it's going to go back to, 10 years ago when China was the driver of growth, or it's all really bad and we're facing an economic collapse. And it's kind of somewhere in the middle, right?
Yeah, well, that's what I'm not sure if it's in the middle. And maybe I am focusing too much on the negative stuff. But what I have seen is that the foreign companies are not investing. They're actually de-investing. And the other thing I have been focusing on is the results of the Western economies in the first half of the year. And a lot of them are showing negative growth. Then one of the things I'm asking my Asian friends is please clue me in as to what is happening with the Chinese companies in the first half of the year. And as it happened, I read a story about the piano business. Why about the piano business? Don't ask me. My brain's a little random. But these companies were seeing sales down by nearly 40% year on year and profit nearly demolished. And I know the piano business doesn't mean anything on a macro basis, but is that a signal of what is happening there? What do you see on consumer demand?
I think it is a signal of consumer demand where there's a huge amount of caution. And we've seen throughout the year a shift from big ticket item spending, consumer goods, maybe pianos for the new houses that people aren't moving into, and more on tourism, travel, and even that, again, we have base effects from last year where everything was open and it sort of let it rip, and now it's coming back down to earth. But there are sectors that are doing well, right? There's electric vehicles, batteries, all the new energy, clean tech industries that are doing really, really well and are supporting oil demand growth. I mean, you asked our views for the year on oil demand growth are around 450 KBD year on year for this year. Although, as Harry and I talked about, we've probably seen most of that growth in the first half. Gas is doing really well. I mean, gas year to date, we've seen double-digit growth rates. And that's probably we're probably going to see, it's probably going to get slow, but we're likely to see an 8% year-on-year demand growth. A lot of that is actually on industrial demand. Again, in some of these new energy sectors, glass, non-ferrous metals, those are holding up. But I think, to your point, what we are seeing is a slight change, and maybe we need a change in mindset. We were used to China being the driver of global economic growth. And if China grows, everybody benefits. I think that's changing. It's China's growing for China and not necessarily for the rest of the world. And even increasingly, China growing at the expense of everybody else. Overcapacity in petrochemicals, that's going to weigh on everyone else. Overcapacity in steel, which is going to weigh on everyone else. And that's part of this mindset of the geopolitics of the world, where China's looking around it and saying, these are really complicated times. We're likely to see some kind of sanction, export bans, controls. We need to beef up our domestic economy. We need to be self-sufficient. So maybe it's not the kind of win-win world anymore, but China itself is still growing.
So let me say now, I would like to break up the conversation and bring it a little bit to Harry. Harry, what do you see as being some bullish elements? And if not, what happens if China doesn't grow at the pace it has? What is the impact to the globe on an economic basis?
Well, I think there are, two parts to your question. When we look at oil demand, right, and so Michal from the Oxford Institute of Energy Studies, they're sort of middle of the roadish in terms of Chinese demand growth at 400 to 500. OPEC's at 700 KBD growth year on year. The IEA is at a more conservative 300 KBD. And we start looking through the various products, and this is what we did with Michal earlier for our show Oil Insights. And we came to the conclusion that actually one of the mainstays of Chinese oil demand growth that makes up pretty much half of Chinese oil demand growth is demand for feedstocks by the petrochemical sector. So whether it be propane or naphtha, there are all these new industries and the electric vehicle industry that require products made by the petrochemical sector. So that leaves us with a hint of bullishness, which means that if the Chinese do not care of being in overcapacity because they'll just simply export their surplus and other people will have to adjust, then demand for these feedstocks, which are the driver of Chinese oil demand this year, are giving us a little bit of hope that China's demand is not going to completely fall apart. And I suppose that is one sort of silver lining around this bearish cloud that we've been discussing in previous shows. What does it mean if China slows down, if it doesn't hit a 5% GDP growth target? Well, at the end of the day, it's an exporting country in terms of manufactured goods. There's a lot of obviously intra-regional trade before exports are redirected towards the main markets of Europe, the US, or even Japan. So we could see other Asian economies obviously suffer from the fallout. But from an oil demand perspective, I think that even if they slip below that 5% economic growth target, the petrochemical sector, I think, Michal, is still a mainstay of growth, and that allows us at least not to be overly bearish on China. There's a few supporting elements from that area.
So, Michal, so LNG is the big thing then in China.
Gas is the big thing. I mean, whether it's LNG, there's been a lot of domestic production, there's pipeline gas, and the Russian flows are still inching up. LNG was very strong at the beginning of the year. Again, probably going to taper off a bit and quite price dependent, actually. And as we were talking about earlier, it's been making inroads into road transport and displacing diesel in China.
So I'm going to say something very impolitic here. As Germany dies, China's petrochemical industry rises, because that's effectively what has happened in the past 3 years.
And increasingly, lots of industries will move to China, not just because they're competitive, but with China's renewable overcapacity, they're going to be able to actually produce those industries and this is a longer term vision, right? This isn't next week and this isn't next month, but they're preparing the groundwork for being competitive also on the carbon footprint of their industries.
Well, I wanted to thank you for joining us in such short notice, and I also want to thank the other guests here in the program. I'll just close up with the following. OPEC, what's going to happen next month? September is the month when the nominations are given for October. And people in Asia are telling me that allocations are going to go up. We will know for sure in the next maybe 9 working days what the allocations are, but if they increase as expected, we'll expect another hit on oil prices. We close it with that. Thank you very much. We'll see you next week.